Hello, everybody. Welcome back from my returning students from the Summer 101 Accounting. Nice to have you back. I was so happy to see all of my returning students. And I also have some new ones. So we have a kind of over full class, but that's okay, no problem. And I wanted to let you guys know that I do have a welcome video. Well, it's not actually a video. I'm not going to make a separate welcome video like I did for 101 because it's exactly the same thing. I do have it posted on e-learning. Of course, you can't go on e-learning till September 8th at 8 a.m. But when you click on the course information, you're going to see the welcome video, and you can download it and print it. And I know I did the video for the first one just so you guys could kind of get to know what the class was all about. Accounting 102 is exactly the same. It's even the same book, as you know. We're just going to finish up the book. So all that's different from this 102 to 101 are the chapter numbers. So I figured I wouldn't do a separate video. They do have an audio that you can click on the little microphone and it'll tell it to you, not in my voice, but that might be a good thing. You know, the computer's voice, but they do have an audio component if you'd rather just listen to it rather than printing it out. It's up to you. But it is the things I talk about on the first day of a regular class meeting. So check it out, or if you have it from the first 101, you can just use it again. Just know the chapter numbers are different. Okay, so for chapter 6, I'm gonna, as usual, give you highlights from the chapter and some things that you should watch out for, pay attention to, things like that. I'm gonna kind of do an overview for a few minutes of the chapter. In video number 2, I'm gonna do a problem example. And also in video number 3, I'm gonna do another problem example that are very related to your homework and labs, okay? So chapter 6 is called Merchandise Inventory, and what it is, the bulk of it, the meat of it, is about how we cost inventory. So some things I'm going to kind of go through. It's not a very long chapter, so that's a good thing. The first couple of pages are 323 to 324. Just read them over. As usual, it starts out with accounting principles and concepts that are applicable to inventory. It's just a couple of pages. The one that I wanted to sort of point out a little bit to you is on page 324. And if you're looking at your slides, it's slide 6-9. It's just one paragraph. It's called the materiality concept. I remember being a student many years ago and being very confused about what this actually meant. All accounting books, you keep seeing the word material. Is it material to the problem? Is this information material or immaterial? And I would raise my hand always and say, what does that mean? And the teacher would always try to quantify it with a number. Oh, materiality means less than 1%. It's immaterial. More than 1%, it's immaterial. Or some teachers told me 0.5%. It all depended what class I was in. And I said, that doesn't sound right. Not to them, of course. But in my mind, from doing accounting for so many years, I'm saying that doesn't sound right. Turns out it isn't right. They give in this book the best definition of materiality that I have ever seen. Okay? It's got the definition it kind of in the middle of 324 and actually on slide 6-9. They give an example, $10,000 as material to a small business if you made a $10,000 error. To a $100,000 revenue business, that's 10% of an error. It's terrible, right? So you can kind of tell it jumps right out at you that needs to be addressed. That needs to be corrected. But if it's a $1 billion company, that's not so material. So they are putting it in they're quantifying it. They're putting numbers with it. So that's kind of an extreme example, but just for a regular, I love the kind of one sentence thing that says, materiality means significance, right? First of all, as it relates to accounting and pretty much as it relates to everything. Information is material or significant when it would cause someone to change their decision. If that error, the significance of that error would cause a decision to be changed, you have to correct it. It is a material error. Okay? So that's basically, I think, a very good rule to go by. So that's all I'm going to say, because I don't dwell on the whole principles and concepts things. Well, I like to mention to read them over so you can see what gets applied, because there are literally hundreds of concepts and principles in accounting. And they mention them in every chapter that we go through, the ones that pertain to what we're doing. So that's enough about that. So it starts on the kind of the bottom half of 325, all the way up to page 336. That's 11, 12 pages, okay? It's a lot. And when you're looking over this portion of the chapter, this is the meat of chapter 6. It's basically telling you, how do we cost this inventory? What kind of numbers could we attribute to the inventory for costing? Now, when we had inventory in chapter 5 back in 101, I always felt bad that 5 and 6 weren't in the same course, because chapter 5 is when we get introduced to the merchandising business with the double entry of the seller. I just have to write this down. I can't. It's the only thing I'm going to write down probably in this video. But just to refresh your memory, what I mean by that is when we got a sale, say it was on account, we would debit accounts receivable, say it was a $10,000 sale, okay? And then we would credit the sales revenue. But when we were the seller, we needed a second entry. And I kind of, when I was a student, made up the little double entry of the seller thing, so I wouldn't forget. Don't forget the cost of goods sold, which keeps the perpetual inventory records rolling along. Because you would never know what your inventory was valued at, or what the expense was, the cost of selling, if you didn't do that second entry, okay? So I'm just kind of reviewing for that from chapter 5. So say the COGS, the cost of goods sold, that's the abbreviation for it, was $7,000. We would debit that, the largest expense of the retailer, right? For the service business, it was payroll. For the retailer, it's cost of goods sold, whatever they paid for the items they're going to turn around and sell and hopefully make a profit, right? And then we credit merchandise inventory because it's leaving your business and going to your buyer. So that would be kind of messy, but that's the double entry of the seller. Right? We're going to see that again. Oh, I already went downhill and I only wrote one, well, a double journal entry. I'll try not to do that, especially when I have to write a lot. Okay, so if you look, it kind of goes along. The first page, I just wanted to catch up with my slides. Wherever I put them, that would be a good thing. Ah, they're hiding. Okay. So the slides, and they do a really, really great job on the slides and in the book of going over each type. The slides go from 614, and I am on page 326. All the way up through each, there's 4 methods. Okay? Don't get scared, they're not that bad. To slide just to the very end, so it's 634, so it's like 20 slides, 21 slides that go along with these examples. I'm not going to spend a lot of time on the examples because that's my second video, is to go through each costing system and show you how to do it. Okay, so just to catch us up with the slides if you're looking at slides. Okay, I'm going to just stick this under here. I got this nifty little table that's hopefully going to help us out here. So there's 4, okay? But if you look at, if I'm looking now at 326, what we did before, why we never saw when we were in chapter 5 one of these kind of, I call them grids or Excel sheets. with how much you purchased, what you sold, what your cost was in your ending inventory. We never really had to spread it out like that and make a big deal because we always paid $350. It never changed, $350. There was no choice. You costed it at $350, no big deal, easy peasy, right? But that's going to change now because in reality, prices rise, they fall, they fluctuate all the time, right? These, what we call cost assumptions, and the assumption is prices are rising or fluctuating. So they go through each type of scenario for each costing system and kind of show you one. The first type, very rare, it's called specific identification. They show it on page 327. Yeah. The bottom of 326 and 327. It's really good for things that you can specifically identify. For example, automobiles have VIN numbers. They're sold by specific identification. Real estate has addresses sold by specific identification. You can pinpoint what you're selling. You know exactly what the cost is. Again, pretty easy, right? There's really no guesswork involved or choices to be made. It's specifically identified. It's also good for very expensive jewelry, the kind of one-of-a-kind pieces, things like that, custom. So we're not going to see it very much. They do show an example of it, though. What we are going to see a lot of are the other three. And the other three, first one called Fifo, first in, first out. What that means is the first thing that came in, the oldest item, is the first item you're going to sell. Does this mean in reality you run around and look for the oldest one and then you send it? In most cases, no. It's an assumption. It is an assumption. The assumption again with the prices changing, you're going to cost the inventory at the oldest items that you got are going to go first. So you're going to sell the cheaper, older items. Okay, that's called Fifo. That's the number one most popular inventory is Fifo. Why? Because for one thing, you have a higher gross profit because your cost of goods sold is low because you're selling the oldest items first. So everybody likes that, except for Gap. Gap hates it because they consider those fake profits. Because how do you know that's what you paid for it? Okay, you're assuming you're taking the old one. It's kind of cheating, they think. They don't really like it. It's not conservative. Okay, they like the second one, Lifo. The last thing you got is the first thing to go out. More expensive goods typically are sold first. Cost of goods sold is high, gross profit is low. The good thing about Lifo is it gives you a tax advantage because remember, we pay taxes on our income, our net income. So if we have a higher cost of goods sold, we'll have a lower gross profit and a lower net income. Good for taxes. Not so good though for presentation of the financial statements to show how good you look. So it's kind of a battle. Okay? If you ever go to a grocery store and you go to grab milk, and most people know this trick, that they're going to put the older milk in the front so it'll sell, and the newer milk in the back. And what do we all do? Well, those of us that buy milk, reach all the way in the back and get the last one we can grab because that's going to have the furthest out date. Okay? That's what they're practicing. They're trying to Fifo it. They're trying to put the oldest things first so it'll sell and the newer things in the back. Fifo is necessary for perishable goods. Very, very necessary. Anything food or something that has a shelf life. Okay? If it doesn't, I sell auto parts. It's not such a big deal, right? Lifo's okay for most, unless they're computer components. Those change a lot. The problem with Lifo is things can get obsolete. If technology, and you hold on to it for too long, it's a problem. So that can be, whoops, I don't know who's doing that. Anyway, there's things, what they allow you to do now, the IRS and GAAP, they let you do a combination of Lifo, Fifo, depending on your business. Before you had to choose one. We're not answering that. You had to choose either Lifo or Fifo, or there's another one. The last one is called weighted average. Oh boy. The average I'm going to talk about in just a minute. It's exactly what you would imagine. It's somewhere in the middle of the two. That's very good for things that are naturally mixed together. Like we have a lot of chemicals that have to go in a car. That's perfect for average costs, such as oil, because it all gets mixed together. Gasoline, anything that's a chemical, household cleaning products. Average is great. It's a perfect costing system because it's a natural mix. So depending on your industry, you could use one or the other or all three. Probably wouldn't use for specific identification as only for those few things I mentioned. So I am not going to go through at this point all of the examples. At the next video, we're going to actually do Lifo, Fifo, and weighted average. The weighted average is probably the littlest grid to do. The only thing, the kind of, I wouldn't say confusion, but the only kind of stickling point with average is you have to have a new average every time you buy something, and it's a different cost. You have to take an average of all of your costs divided by all of your goods, and that's the weighted average. The reason weighted is put in front of average, and it's not just an actual average, like in other words, say you had 3 costs. You wouldn't add up all the costs and divide by 3. You would add up all the costs and divide it by all of the units. So that'll have a natural weight. Say you have 70 units at $20, right? And you only have 15 units at $10. The weight is going to go closer to the 20 because you have more of them. The weight's going to go to wherever it's biggest, whatever the quantity is the largest. So that's why they call it weight, because the higher unit carries the weight. Okay, so you're going to see that coming up in video too. So what else do I want to tell you? Just to mention the pages, I mentioned the slides, but the pages, specific identification is on 327. FIFO is on 328 and 29. Lifo 330 and 31. And weighted average 332 to 333. So there are a couple of pages apiece. And one page, the first one will show you the grid. I call it a grid. It could be an Excel sheet. It's just, columns, rows and columns and rows. And the second page to show you the example will show you the journal entries to go with them, right? The problem I'm going to do with you guys is just like a homework problem. It's actually exercise 620. It doesn't have journal entries required, so you won't see that. But if you just go to like if you're doing FIFO, just go to page 329 and see how the journal entries are made, okay? The example is great. So, I'm going to skip over now past that. Let's see, after weighted average. Okay, so 334 to 336, the financials, how financial statements are affected by the methods you choose. That's a pretty easy read. You can just go over it and you can see the what the gross profit is for each method and how it affects the income statement and the balance sheet. That's pretty self-explanatory. And there's a little chart at the bottom that can be confusing. Exhibit 6-9 on page 336. Stick with the top periods of rising costs, because that's what all books show you. You don't even want to think about the downward costs, because there's never any of those problems. Can that happen in reality? Yes. But if prices are always dropping, say, what can I give an example? Say like old cell phones, right? And not the price keeps dropping on older model cell phones. So we would have to go into the bottom, but you do not have to worry about that right now. It's just everything becomes the opposite of what they're teaching you here. Everything goes the other way. It's like a flip-flop. And I'm surprised they put that there. And I always tell students, even in my in-person classes, which are, have been for the last 18 years, just ignore that. Just know it's there and it can happen, but we're never going to do any problems where it constantly goes down. We have fluctuating prices though, okay? And then the next concept, which is on 337, and the little bit on 338, very easy concept. It's a rule put out by the accounting board, the standards board, and GAAP. It's called the lower of cost or market rule. It's very simple. Such as the cell phones that I mentioned, if your inventory loses market value, you should change your historical costs, what you actually paid for the components, down to the market value. And on your financial statements, it'll state what you use. That you use Fifo, lower of cost or market, and I think Smart Touch Learning does. Yes. Merchandise inventory are carried at lower of cost or market, and costs are determined with Fifo, first in, first out. So that's their method, and that's always stated on the financial statements, usually in the notes to the financial statements. All they're going to give you an example of that. It's at the bottom of the page. It's very, very easy. Just take the difference between what the market value is and what you originally paid and recorded it. This one here is tablets they paid $3,000 for, and now they're down to $2,200. They declined in value because they got old and the newer things replaced it. That's a difference of $800 between the cost they paid and now the market value. And this is the end of the period. You need to write that. We call it writing the inventory down. You use an adjusting entry for it, and you always charge it to cost of goods sold and credit the inventory for the difference between your cost and the market. That's all there is to that. It's pretty easy. So, the other thing that's kind of a pain in this chapter is going to be my third video, and that's errors. Errors are always a pain. Errors you have to fix. This is page 339 and 340. My video 3 is going to have a very similar example that you see on 340 with the 3 years with errors occurring and how we are going to fix them and restate. So that's going to be just like problem, we're going to do 6-36B for that one. So you see the effective inventory errors, the example. Again, you're going to have a homework problem that looks like that. I think it's a lab problem, actually. And the effects of inventory errors on the bottom of 340. Again, I'm not going to spend a lot of time going over this example because I have another one to show you. Not that it's not a good example, but the one in the lab is like the lab problem. So I think it's better served. The last thing I'm going to tell you in this video is on page 342 is our end of the chapter ratio problem. It's a two-parter. How many times a year does the inventory turn over, which means come in and then get sold? And how many days does each turn take? So this is kind of a double one. Very much like from chapter 9 when we did the receivables. How many times do the receivables get paid in a year? How much does each turn of receivables take? How many days? This is very similar to that. In my third video, when I do the example, they ask for 3 years of these. I'm just gonna show you one because it's so easy to do. You just follow the formula. It shows you Kohl's here. You do Cost of goods sold is the numerator. Average merchandise inventory beginning plus N divided by 2 is the denominator. You get a number. And then for the days, you do 365 over the turnover ratio. Again, so similar to that accounts receivable one in Chapter 9, except now we're using inventory as the denominator. Same numerator. So, I think I've told you everything about my highlights. So I'm going to close, and I'll see you back in a couple of minutes when I set up my Lifo, Fifo average cost problem. See you in a minute.